right, hello everyone. Welcome back to the Financial Shepherd Happy Hour. I'm here with video editing genius Ezra Kellerman. Appreciate everything you do for the show. It's a pleasure to be back here at a new spot, of course. You can see the new background with Pensive Distilling in Newport, Kentucky. This place is awesome. This was your idea, so why don't you tell the folks a little bit about this place?
Well, as you said, I'm a genius, and it was my idea to come down to one of the lovely local establishments here in Newport, Kentucky, Pensive Distillery and Tavern.
Yeah, so as you can see right behind us, they make their own bourbon, vodka, and some other spirits. Only been here a year, so you're going to start to see some more of the bourbon on shelves probably in the next few years as they age that, but vodka is already out there. They're going to have live music tonight. Very cool atmosphere right here in Newport, Kentucky. We're very appreciative for them having us here to do the happy hour show. And we got a little bit to cover today. Next week's a huge week for the market, so I'm excited to share some of this information with everyone today. But as I wanted to start with something that you're a little bit familiar with, I know that you don't manage money for a living, you're not a financial advisor, but you are an investor.
I do spend money.
You do spend money. You do participate in this economy here in the United States. So Snap, the app, absolutely terrible day today. So we're right in the beginnings of earnings. They had lower subscription growth, all kinds of issues with their earnings call. The stock was down, last I saw, north of 35% just in one day. So earnings has overall been very good, not just so far this quarter, but so far this year in 2022, even though we've had just a whole bunch of negativity and overall negative performance for pretty much every sector in the S&P 500, with one exception, that being energy. And right now, we're getting ready to go into, in my opinion, probably the most important, definitely one of the most important earnings weeks next week. On top of that, we had the Federal Reserve meeting on the 27th, 28th, where they're going to be announcing their Federal Reserve interest rate hikes. And the big earnings that we have on deck next week, I'll just kind of read that off for everyone here listening to the show. July 26th, on Tuesday, we have Google announcing their performance after the close. Microsoft is going to come out on the 27th after the close. Amazon's on Thursday after the close. And of course, we're going to wrap up the week on Friday the 29th with AbbVie, Procter & Gamble, ExxonMobil. We have a whole bunch of other large name companies like Coca-Cola, Pepsi, and a whole bunch of others also going to be announcing earnings next week. So it's a huge week of earnings. Really what everyone's going to be paying attention to. I would call it the Super Bowl of announcements almost every month or every other month, depending on when the Fed has their breaks. Is what is the next interest rate hike going to be? Is it going to be 75 basis points? Is it going to be a full 1%? The market is leaning towards a 75 basis point hike right now. If you look at futures or interest rates, please keep in mind, trying to predict interest rates is kind of like trying to predict the weather. Very difficult thing to do. Not going to be consistent about it. However, we came out of one of the worst inflation headlines that we've seen in 40 years. It's been a very hot inflation data, almost every report. The last one last week was no exception to that. So we had an increase in inflation. Prior to the most recent announcement, inflation was coming in at 8.6%, which again was a 40-year high. We haven't seen since 1980, 81, and 2. And the most recent reading last week came in at 9.1%, which is what had the market thinking that the Fed would have to increase interest rates by a full 100 basis points or 1%. That very well may be happening. That may actually be the right thing to do. But the reason why most of the market analysts don't believe that that's actually going to be the case is simply due to the fact that we have strong labor markets in this country. So we'll actually wait and see what happens. I personally don't plan on taking a lot of action for client portfolios unless something significant happens, just because I want to see what these earnings are going to be. And most importantly, I do believe that revenue will be good. I think a lot of these companies will probably beat their earnings per share estimate, but the most important thing investors are going to be listening for is what is the future guidance? What is the CEOs, CFOs, and board of directors for these companies that are going to be announcing their earnings next week? What are they going to project out over the next 6 to 12 months? That is, in fact, all year long has been the most important thing. That has either had shares rise or had their shares significantly get cut in half, or even worse than that. Snap was the most recent victim of all that. However, as I usually do, coming prepared for all these meetings with a whole bunch of data.
Data energy.
That's right. It's very important. So I'm going to read a little bit from the most recent Barron's article. Subscriber of that. So Jeremy Siegel, he is a professor at the Wharton School of Business in Pennsylvania, and here's what he has to say about the current market environments. He's very optimistic on the long run performance for stocks, of course, and basically what he had to say is the Federal Reserve stopped the growth of the money supply this year very dramatically. That wasn't the case during the Great Inflation of 1968 to 1983 when the Consumer Price Index, which is the key measure for inflation data here, that surged 186%. Today's valuations, according to Professor Jeremy Siegel, look very attractive. He says, I wouldn't predict that we've hit a bottom just yet. No one can predict that, but investors in this market may very well be rewarded if they are patient, if you're dollar cost averaging. So if you're not retired yet, you're still contributing to your 401k plan every time you get paid. If you're contributing to your IRA accounts on a monthly basis, that's something that I do here personally. Every Monday, I have X amount of dollars automatically shifted out of a checking savings account into an investment account, and I put that capital to work. That's the benefit of dollar cost averaging. For those that haven't followed the show, it's if you're making those regular investments like you are in your 401k, your IRAs while you're working, you're going to be investing sometimes at price points that are very attractive, like what we're in right now at a lower price. If you were doing that for the previous 3 years, we had nothing but double-digit gains every single year for 3 straight years leading up to 2022. You still made money, but you were buying the same sort of shares at a higher price.
Right.
So that is something that if you're still working, you should have an automated plan for. And if you're retired, you can rebalance the portfolio, just as Professor Jeremy Siegel is kind of outlaid here. Yes, this is a very difficult market here, but all that does is produce opportunities. And if you have a well-diversified portfolio, you do have some energy exposure specifically this year, you got some positions that you can actually take some profits away from and apply that to other parts of your account, specifically technology is underperforming market the most so far this year. And that's exactly what I've been talking with my clients about. We're right in the middle of all the quarterly reviews for all of my clients. We haven't wrapped them up yet, but that's the reason why it's so important to have a regular conversation with your financial advisor. Not only do we do this show, we do monthly newsletters, and certainly we have quarterly reviews with all clients every single quarter, and we're right in the middle of all of that. Now, in addition to that, the last little bit of research I wanted to share with everyone today before we wrap up this Friday's happy hour. Hopefully, a lot of you folks will actually join us here on Fridays in the future. Come out to Pensive Distillery Company again, right in Newport, Kentucky. We're going to be here every Friday around 4 o'clock. Start to shoot the show around 4:15 once we get everything set up. Please feel free to join us. You can ask questions. You can put those questions right in YouTube Live. You can text me at 513-630-2664. It's going to be a great time, and I know that we're certainly going to enjoy ourselves after the show for just a little bit before we hit a Reds game.
Going to a Reds game.
See what happens with the hometown team here tonight. But the last data point that I wanted to share with everybody, and this is coming from the Cinnamon Trader. This is a subscription that we have here at Shepherd Wealth Management. And essentially what it's showing to us is that prices of company securities, so publicly traded stocks, are well below their 200-day moving average. So this is a technical indicator. Usually I talk to everyone about fundamentals. I'm very much a Warren Buffett style type of investor. I like to look at PE ratios, balance sheets, and income statements. I know that that's not your favorite thing in the world. I'm sure for most people watching out there, you don't have the time or desire to go through all that because it is a lot of reading. It is a lot of statistical type of analysis that you want to go through there. But simply put, when the major indices are below their 200-day moving average, it's just a great indicator of really two things. One, we're in a downtrend, right? Stocks are having lower highs, And in addition to that, you're also seeing the PE multiple of the overall market come down. We started out the year with the S&P 500 PE ratio being right about 22, historically at 16. As we're talking right now, we're right around that historical average. So you can reasonably look at the situation that we're in right now and say, hey, the market may or may not be fairly valued, but if we see any depreciation in prices again, you can probably feel pretty comfortable saying, hey, now the market is undervalued. And if you're doing that consistently, either dollar cost averaging or rebalancing occasionally throughout the year, throughout the quarter, you can realistically expect to pick up prices. Maybe not at the bottom because it's impossible to predict the bottom. Even if you get lucky, you caught it.
Yeah.
You can't repeat that process consistently. You can start to look at things and say, hey, this is a reasonable reason I should feel optimistic that the future performance of the companies that I think have an attractive price right now will actually grow over time. And that's exactly the type of research that we want to be able to do in addition to the fundamental analysis. All this technical research is just giving you a potentially attractive entry point. I like to kind of combine 95% of my research on the fundamental side, the other 5-10% looking at technical indicators, just so I have an idea of whether or not we're getting a realistically attractive price. And by the way, when the market's been this bad, this long, generally 12 months out, I typically see the market average around a 20% average annualized return. Now, again, these are averages. It could be lower than that. It could be much better than that. There have been exceptions in time where that hasn't happened, but on average, that has certainly been the case. Now, I am required as a certified financial planning professional to tell you that past performance has no guarantee of future results. It's just like the newsletter I sent out to all of my clients in the past month. The one thing that Warren Buffett had to say about human beings as it relates to history is that human beings do not learn from history. So that's a big reason why we do this show. It's because we can tell you the facts just like the news without scaring you to death and actually give you some perspective about what history has had to say.
Yes, and I think they're both good to hear. Perspective about precedent, historical precedent, but also knowing that you really can't predict it. So there is a small chance. That doesn't mean that you should trade like it's the end of the world, and also don't sit on your hands, because one of the things I've learned from Joshua is a great quote by Warren Buffett, which is fearful when other people are greedy, greedy when other people are fearful.
Yeah, and
Keep
the
with
last
reason.
The last thing I'll say about that is Buffett has done exactly that. He's put more money to work so far this year than he has in a very long time. And if you look at the trades that he's placed, and the performance in the first 6 months of the year is not good. Not good at all. But he's making these decisions because he's looking out to the future and saying, I believe over the next 5-10 plus years that we're getting a very attractive price relative to what these companies were worth just 12, 18 months ago. So price is what you would pay, value is what you're going to get. It's another great quote from Warren Buffett. Ezra, I think that we've done all the damage that we can do here today on this Friday's happy hour.
They're actually kicking us out right now.
This has been wonderful. Please join us, and hope everybody has a great Friday, has a great weekend. My name is Joshua Casey Garland. I'm a certified financial planning professional, the owner of Shepherd Wealth Management. It's been a great pleasure to be here. I hope you all join us next Friday for the next Financial Shepherd Happy Hour. Ezra and I are going to go catch the Reds game. So
we catch the Reds game. I want to say a final thank you to Pensive Distillery, 720 Monmouth in Newport, Kentucky. They got live music tonight, make their own bourbon. We'll be here every Friday. For those of you that are catching the show on the archive on the YouTube channel, leave a question in the comments for Joshua, anything about finance. Feel free to join us here live next week.
Thank you. Cheers.
Cheers. Thanks for getting us down the office.